So there's so much going on with the market right now. There's these, everybody's wondering when the market's going to bottom. I have some thoughts on that. We'll get to that in a little bit. For you guys just joining us, feel free to hang on to your questions. Feel free to leave comments, but hang on to your questions until we're about, 20, 30 minutes in. Then hit us up with some questions. We love to answer them for you guys. Whatever you guys want. You guys want to see some charts? You guys want to see what we're thinking on certain topics? Feel free to ask. First slide here today, Kashop, you brought this up, today. You sent it to me. What are we looking at here?
So gold hit 3000, and that's a historic milestone. Not because 3000 is better than 29.99 or whatever, but it's like when I ping someone who bought gold with me back when I was buying in 2014, 15, I tell them, hey, you know what? I haven't talked to you in a while, but I just want to let you know gold is $2983.5 an ounce. And that makes, that's just ridiculous. When I say, hey, you know what? Gold is now $3,000 an ounce. Now that's an icebreaker. That's a nice way to start a conversation, right? So I think the $3,000 milestone, it's more about let's just enjoy it and make it a social celebration or something like that. So when I see gold hit that milestone, that's what it means to me. Like, I've been buying gold since 2014. I think as long as I'm earning, I'm going to be putting some part of my savings in gold, silver, but mostly gold. Like, I don't think that's ever going to change. And that's because you have the cultural history. And in fact, so let me tell you something. Like, in my country, that's India, it's very, very common for gold to get passed down for three generations.
Hmm.
Fourth generation, not as common. Fifth generation, a little rare, but three generations is quite common. So, when we accumulate gold, it's not something that, whether it's $3,000 or $30,000, it doesn't really make a difference because you're taking a generational view. But having said that, let's get onto this slide, which looks at the miners. So now this slide is all the miners which are not producing. That is, they have properties in various stages of development. These are not revenue generating operations. And if you look at the performance of these stocks, it's like everywhere I look, it's a sea of green. So there are two columns which are color coded. The first one is the percentage change, that's today's percentage change. The next one is the year to date. And if you look at the year to date, some of them have been absolute stunning, right? I mean, there's a stock which is Double View Gold, which is at 121%. There is Aras, which is at 250%, and Goliath Resources, which is actually in my portfolio, which I recommended to subscribers. That's up 95% this year. And these are crazy, crazy returns considering we are just something like 45 trading, 50 trading days into the year. That's it. And the returns have been wild. So now when people say, oh, yeah, the market is correcting, and like, I have 30% of my portfolio in these exploration stocks. Not everything you see on this list is like a small subset of the ones I track, but I have 30% of my portfolio in these stocks. And I look at it and it's a sea of green when someone tells me, in panic that the market is going down, the Max 7 is going down, US economy is in crisis. I'm like, hold your horses. Why are you in yesterday's trade? That's really the problem. Like, you are in yesterday's trade. Like, yeah, the US economy, whatever it did, the markets did very well, starting with the Fed pivot when they rescued Silicon Valley Bank, when Germany rescued Credit Suisse. From then until now, it's been non-stop, just max 7, max 7, max 7. And then the market changed. So you either get along with the change, or you stick to yesterday's trade and complain, man, it's going down, it's going down. How much longer can it go? Does it bottom here and bounce? Maybe it does, but again, does that really matter? Does it matter if the market bottoms today here and bounces? No, because you're not really going to get your money's worth if you're in a trade that's maybe making 5% over the rest of this year with incredible chop. You want to be in the trade that's going to make 20-30% this year with little downside volatility. And where do you get those trades? You get that by looking outside of what everyone else is focused on, which is the S&P 500, the Nasdaq, the Dow, whatever is your index of choice. You get that by looking at what's happening to the dollar, what's happening to interest rates, what's happening on the macroeconomic front? What's happening in China? What's happening with international stocks? Where are the flows going? Why the hell are European banks performing so well this year?
Yeah,
It's a mystery. But
it
if you
is.
solve that mystery, that gets you somewhere else. So
Yes.
that's what you should be looking at. And I just want to say, look at this chart, the picture that I put up, and look at the sea of green and realize that there is tremendous opportunity in this market. You just need to look in a different place.
And that's why what we focus on here, like none of us are what there's plenty of times where we're gonna say, hey, we really don't like gold miners. Like there's times like that where there's nothing to do in gold miners. There's other times where gold is great and it's the thing that's leading everything else. There's times where we're gonna look at China. That's macro trading as a whole. Like I have always tried to keep the most open mind to investing in different areas. If you go to my Substack channel, you'll see I talk about this a lot, or traveling all over the world and seeing different things, how it kind of changed my views on these things. Not that I ever had the view when I started trading that like you had to be one place and one place only, but it definitely opened my mind to, hey, there's other things out here. There's lots of things to trade. If you're a commodities trader, you have to then start look at commodity currencies. If you look at commodity currencies, you have to look at the countries that produce commodities and so on. Like you just continue down that road, and like Kashop said, look at the European banks. Ask yourself why, and then go, okay, well, what are these banks invested in? How did they come up with these types of returns? Like you just go down that rabbit hole until you figure out, okay, well, now I can invest in this area from that trade. Um, so I just think that so many people are so stuck in the S&P 500. Technology has to be it or nothing. Like that's been the continuous theme over our entire career, which has been tech or nothing. It's cool that you guys want to, buy these other things or trade in these different ways. But really, tech's going to outperform everything forever. And it's just not true. Are we trading on a 50-year time frame? Maybe technology in the United States outperforms some things one more time over 50 years. I'd be surprised, but let's say it happens. Um, Over the next year, though, China could lead the way once again and be the strongest country again. And most people could be sitting on their hands and going, well, technology is going to do great next year. What's the point? Are you trading or are you investing? Like, if you're investing, sure, do whatever you want to do. This is a trading channel. As a swing trader, as a position trader, you got to always find where the strength is. Strength right now is in gold miners. I know everybody keeps talking about the trade. Every time I talk about it, hey, gold's outperforming the S&P. Somebody gets mad, talks about how gold underperformed for 10 years. That's fine. Sure. It doesn't matter. Some things will underperform for 10 years and then outperform for 10 years. Do you want to continue to be in the next underperformer for 10 years? Then rotate to the next thing. And when the trend changes and when these aren't outperformers anymore, we're going to be out and on to the next trade. So, we got a bunch of good slides to go through today. And just because there's so much going on in the markets right now. And so, I wanted to bring this up once again, which you guys have all seen this chart if you've watched the show before. But for those who are new, it's bonds against commodities is the blue line. The New York Stock Exchange against commodities is the red line. And then that's the, United States stocks. And then gold. Oh, there's a lot of stuff in there, but stocks in the United States are listed on the New York Stock Exchange, and then gold against commodities. As you're seeing, gold is outperforming everything, just ripping to the upside still. And what you're also seeing is there's some divergence, though. Most of the time, these lines kind of go together. You kind of see that, gold, if the stocks are outperforming commodities, sometimes it's an environment where gold can outperform commodities. But now gold is outperforming everything, whether it's commodities, stocks, bonds, you name it, it's massively outperforming it. Bonds, yes, everybody keeps talking about the little bounce in bonds that we've seen. That's cute. It's adorable. Is it really going somewhere? I'd be surprised. I think over the next 5 years, we could just see bounces in bonds. Yeah, we could see they're tradable. If you want to trade them, if you're short term, go ahead. But I think in the long run, we're just going to see lower and lower bond prices going forward. But now if we look at the red line, which is the New York Stock Exchange against commodities, we are seeing that did roll over against commodities recently while gold was going higher. That's an interesting divergence, something that I continue to kind of want to talk about here, because as that continues that direction, we could see money flowing into other areas. Once again, back in the commodity complex, international stocks are kind of saying it. The dollar's also saying it. And then this is commodities against bonds. You're also seeing this massive pennant pattern. So if we look at this dot-com bust back to 2000, oil hits under $10 a barrel, and basically tech stocks are at all-time highs because of the dot-com bubble. Dot-com bubble burst. Next thing you know, commodities take off for 10 years, and then they go the other direction for another 12 years, basically. They bottom out in COVID, basically take the COVID crash, the best capitulation moment for energy ever, where the front month contract in oil went negative, and then it bounced the other direction. And now it just consolidated sideways after such a huge rate of change move over 2 years from 2020 into 2022. And now it's moving higher. It broke out, it retests. Why I left the thumbnail over here is because you're seeing that bounce back up higher. Usually when you see this ratio moving higher, you do see the commodities are going to start to follow it as well. We've seen it in certain areas, but I think this is all based on the dollar. The dollar being the biggest common denominator of all of these different markets. Obviously, it's the world's reserve currency. And if we're looking at this chart, it's basically showing you the rate of change in the dollar. Now, rate of change just means how quickly these moves have happened. So if we're looking at some of these moves and they've happened so quickly, they usually lead to more downside, meaning we see massive selling pressure, and then all of a sudden a lot of sellers, there's a lot more sellers than buyers, and this doesn't create a bottom. This usually creates a continuation move. So I think that for those reasons, we could start to see money flow into the commodities space. I think gold will continue to rip everybody's face off because nobody's still interested in it, Kashop. I think that's something you could talk about a bit. You know, nobody's interested in the gold trade at the moment. So what do you think about that fact that still gold is $3,000 and everybody's like, this can't continue, this is stupid, stop buying gold?
Yeah, I mean, everyone's so into digital assets and, Bitcoin and the whole digital gold narrative, or why we don't need gold anymore because, we have cryptocurrencies. And that's just a terrible way of looking at gold. And I think somewhere it's caught the fever because there are a lot of these gold guys who went on to promote Bitcoin. So, they have spoken to the community on both sides, and some of the arguments make sense, hard money and all that, government can't print it, all that stuff. Like, that's all fine. In fact, you remember I used to be a big Bitcoin proponent until exactly last March. That's when I made a post saying, what, I'm out of Bitcoin, I'm completely into gold, and I called that rotation. And I think that was the perfect call. I didn't know it would turn out to be that way. That was just what made sense to me. So when I look at what's happening with gold, it's what people don't get is, yes, you like cryptocurrencies, fine. You like other hard assets, fine. But like I said when we started our conversation, you can pass down gold for 3 generations. Now, you can do that with real estate, you can do that with mineral rights, anything that's hard asset based, particularly in the United States. You can probably do that with silver, but I think if you passed on silver for even like 1 generation, it's going to be so tarnished, it'll probably lose 3-4% of its value. Nothing is going to hold its value over generations the way gold does. And some people, like especially the wealthy, if you look at the big Ford Foundation, the Carnegie Foundation, all those guys, what they do is they structure their assets, like they form trusts, they form foundations, they figure out which jurisdiction to hold their assets in, and they do all kinds of planning. So I live in Dubai. We have a place here called the DIFC, the Dubai International Financial Center, and people set up family offices there. And that's just in order to pass down wealth. Gold does all of this just by existing. You don't need complicated legal structure. You don't even need to have any knowledge of finance or how the world works. Nothing. You just buy gold, you own it, doesn't lose value, doesn't tarnish, and it's pretty simple to hold, like 1 2 kilo, that is, I don't know, it's like 30 ounces. You want to hold 30 40 ounces, it's pretty easy. You want to hold even a 400-ounce bar, it's pretty easy. It's not going to take up too much space, it's not going to get, rusted or tarnished or anything, and you can pass it down from one generation to the next. The appeal of that, people don't get it because we live in an attention economy where everything has to be now. So you want to
Yes.
invest in gold, you have to find some form of leverage. And that's also what's happening with cryptocurrencies. So Coinbase is offering DeFi products wherein you can take a loan of your crypto on the platform. Now, anyone who's lived through the 2022 bear market knows why that's such a bad idea. But there's a new crop of people coming into the market and figuring that out now. So I think once the downside of market participation, the downside of leverage trading, the downside of just being in the instant gratification economy, once people start to realize that, they will start looking at gold as a store of value, as something that you can pass on as your legacy. So I think at that point is when we'll start to see gold picking up. Now, you can look at GLD ETF flows, you can look at what's happening in the futures markets, what's happening in the Bank of England, and that is all fine if you're trading it. But if you're holding it as a generational asset, then you really have to think through the other parts of it. And I think that's something that the market is missing because no one talks about it, right? Like, if you are a broker, you make your money on commissions, so you need to churn the portfolio. Even if you're an active manager and you say, I'm going to just put on this one trade and sit on my ass for the next 10 years, no one's going to give you money. But with gold, that's pretty much what you have to do. You have to just buy it and just sit on it, and that's it.
I've been like that, for years, and you and I have always both been big gold proponents. Not in a hey, trading is something different. I will ride a trend in gold. When the trend breaks, I will then sell it, and I have no problem shorting gold as well. But as a long term hold, just something to have in your family, I think it's a great thing, and I think there's certain times to do it. For me, it's been 2016, 2017, great times to kind of do that. Get back into what was it? 2018 was another time that was good. COVID was another time that was good. A few years ago, around 2022, was also a good time. There were some times to do it. And I think, over the long run, just because of its monetary value, it probably is fine to do it whenever you want. Meb Faber actually just came out with a paper buying gold at all-time highs and how it's a great time to buy it, because usually when it hits all-time highs, it usually continues. And so once again, I'm just looking at this and going, more importantly, there are so many good mining stocks out there, and Wavy just put out a great question, which are, what are two really good looking mining stocks technically? We don't have to talk about it technically speaking, Kashapa, whatever you're looking for. And let's keep it, I know you have so many of these small cap names where the massive outperformance is going to be. So let's just keep it to a couple large cap names. Some of the names that everybody kind of knows, who's in the gold mining space, that you would say, hey, these are pretty good. I know you don't like NEM, certain names, but some other names that you think are pretty good names that are in a large cap space.
Sure. So NEM, the problem is they acquired too many mines and now they are in the digestion phase. So it's not that it's a bad company, it's just that they have done some moves that it's going to take them a long while to get out of. So outside of that, if I just go through my list of the large caps, I like IM Gold here. That's a $3.4 billion market cap company. So apart from one mine in Africa, all their assets are in Canada. And I think, given everything that's going on in the world today, Canadian assets are at a premium. So I like that one. And I like Aris Mining, which is in Colombia. That's a 1 billion market cap company. I like Centera, which is in US and Turkey. So maybe a little more risky compared to the other miners, but the valuation is compelling. And then you go down the market cap list, there are so many stocks. And in fact, at this point, it's like, when you have a crypto bubble, you just buy the top 100. And it's kind of like that. Whatever you buy, you're going to make money. Now, the problem of discerning quality comes when the trend just stalls. Doesn't have to reverse, it just has to stall out. Then everyone's going to leave the momentum names, and only the good ones you can continue holding for the long term and make a good multiple on it. So at this point, I think you can just buy anything. When the consolidation happens, you want to rotate into quality. Now, by quality, I don't mean you buy Agnico Eagle at it's priced at 5 times sales. Now, that's an okay valuation maybe for a tech stock, but when you look at a gold mining stock and all the risks that you're taking, when you're paying 5 times sales, what kind of upside are you going to get? 20%, 30%? I don't think you get much more than that. Whereas you pay 1 time sales or 2 times sales, your upside is going to be so much more. So, you have to think in terms of what kind of risks are you willing to take. But the flip side is, a company that's selling at 1 time sales or 2 times sales, let's say, they'll have just a single mine. And if something goes wrong in that mine, then the stock crashes 80%, never to recover. So last year was the perfect example. So there was this company, Victoria Gold. I recommended it. I personally lost 80% on that stock. So what happened was they had a accident at the heap leach pad, led to a mountain slide. Cyanide got into the water. It was pretty nasty, and that's it. The company got delisted. So accidents like this happen. And another example, SSR Mining. I wasn't involved in that. So they had an operation in Turkey. In fact, they bet the entire company on the Turkey mine, and that suffered an accident. Around 13 miners died, and because of that, all hell broke loose. So, you have issues like this. Or Centeras. The reason I bring up Centera, it's like so cheap, is because they had a mine in one of the stans, and what happened was the government just took that mine, so the market cap dipped. So you can have all these kinds of accidents when you buy something cheap, whereas you overpay for quality and you buy something like Agnico, which has all sorts of different mines, mostly in Canada and Mexico and Finland, all good jurisdictions. You don't take those risks. So it's a question of what kind of risk are you willing to stomach for what reward you're going to get. And that's really the thing in mining. So it's not like when you look at a tech stock, when you think about it, so you have sales, you have a pretty steady business. Like Apple makes $400 billion a year or something in sales. It's not going to go to 200 the next year. That's not going to happen. Maybe you have a little bit of the change in multiple. Maybe instead of the market awarding it a price to sales multiple of 10x, the market may say it's only worth 8x, but you're never going to have a catastrophic quick loss due to one single event. Whereas with mining stocks, that happens all the time. So you really need to build a portfolio, and you need to build it so that the risk characteristics of the whole portfolio are something you're comfortable with. And what I mean by that is, let's say you only want miners with several mines and no single mines. So you buy a basket of miners which all have multiple mines. Now, what if all of them have operations in a single country? So you buy a bunch of 5 stocks, and all these 5 companies have a mine in, say, Senegal or Mali. Something goes wrong in Mali, then the entire basket takes a hit. So you want to be diversified and you want to avoid those risks, or you at least want to know what kind of risks you're taking so you can mitigate for them and figure out if the upside is worth it. And that's why, if you're just looking at what the returns these miners have given or what the technicals look like, so technicals can tell you what the market is doing. Technicals cannot tell you or foresee problems that happen in a company's operations. That's fundamentals. So when something like recently Alphamin, it's a tin stock in the Democratic Republic of Congo, took a big hit when they had to evacuate all the personnel because uh, the guerrilla uh, warfare had broken out and a rival group had taken control of the city, and it was a huge geopolitical mess. So when that happened, the stock tanked. So you really have to be aware of the risks you're taking. It's not that, oh wow, this stock has a great looking chart, I'm going to buy it. You need to know where they are operating. At the same time, if you bought Ivanhoe Mines when they took on the DRC risk and in fact de-risked the entire country for the Western mining space, you did extremely well. So it's about, you go into a country, at what point do you go into a country? And it's something we talked about in the last call as well, where I mentioned how China is similar to Eastern Europe opening up. There was a time to invest in Eastern Europe and a time to stay out. And you really had to know the difference. And that comes from understanding the macro, that comes from deep analysis of the space. So if you're just getting into gold miners, I would suggest just subscribe to a newsletter and really understand the industry, or stick with the ETFs, stick with the large caps, and don't try to get into these stocks which have these high return potential, because the risk, you will not understand it unless you really understand the fundamentals.
I think there's another answer too, which is you could diversify some of these picks. Sure, and maybe you get 2 out of 5 that do well. But I think the real answer is find a manager, find somebody that you trust in the space. I think no matter what, like even if you're the best fundamental technical investor in the world, you're going to run into problems with just about anything that's in that very small cap space. Small caps and micro caps, there's so many risks out there that you just don't know. And you can't know. It doesn't happen easily. It happens from a lot of research to find out those risks and see if you still want to take on the risk. But if you're always thinking of trading and your idea is to make money, you always got to think of risk to reward. So if you see those risks, and like Kashop said, investing outside the United States, investing outside of Canada could be a little bit tough right now. So kind of sticking to those areas will kind of save you some money, because you always have to think of the downside more than the upside. That's what we do as traders. That's why we make money. So getting to the next chart, get through a couple more of these before we have to go. But I want to look at the year-to-date performance. Steve and I were talking about this yesterday. We really didn't get to dig deep into it, but look at copper. I used this in my in Substack yesterday because it just really says what's going on. We're looking at copper. We're looking at Europe. We're looking at gold. We're looking at ILF, which is Latin America. And then you're looking at the S&P 500. The XLK is down more than 10% year to date. The S&P is down over 5% year to date. It's just telling you a story. And yeah, I have a thought about the S&P 500 possibly making a bounce here, but at the same time, do I want to own the S&P 500 when the rest of the world looks like this? No, I'd rather own the rest of the world. Even if the S&P is going up, these are going to go up even more. And if the S&P is going down, these are going to lose the least. So once again, thinking about it like risk to reward, I'd rather own these things. And we own a lot of these at the moment. And the only reason is because they're going up. It's not because I really like China or Poland's my favorite place I visited. It's just, hey, these are going up. I want to go where the macro is telling me to go, which macro is telling me to go this direction. Relative strength is telling me to go this direction. They're all breaking out of bases. And the United States, the thing that kind of drives it, and one thing that I'm always looking at is one of my favorite canaries in the coal mine, which is semiconductors. Semiconductors to the S&P 500 is rolling over, and it's been rolling over. It's been making lower highs since last year. It's almost a full year of lower highs, and what we call this, it's an old school technical phrase, but it's called a fallen angel pattern. Basically, it makes a high, it goes down, it tries to hit that high again, it doesn't. It tries to hit that high once again, it doesn't. Another time, doesn't. So it continues to make lower highs. Think of Bitcoin in 2018. Bitcoin 2018 continued to make lower highs again and again and again, and then it broke down really heavily. This pattern looks very similar. So, semiconductors, meaning most of technology, because most of technology will follow the semiconductor sector, is probably going to lag at the moment in the United States. But the reason why I'm saying we probably have a bottom here is there's a massive divergence on the higher new highs, new lows. The tick index hit major sell-off levels. The VVIX to VIX ratio, all of these things were kind of saying, hey, we're probably going to see a bounce here. And that can happen. I'm sure we could see a bounce, but I still would rather be in these other areas. So basically just saying, hey, you guys want to sell a put spread on the S&P 500 today, probably great idea. You want to buy it, hold it for the next few months or swing trade it, I probably wouldn't do that. I would rather be in these other areas as we're starting to see that index tick up, though it's saying something. So one more thing real fast, which is the copper to China. And so Kashop, as you know, we've talked about this a bunch, which we keep, and I keep beating this. I just keep pounding the table on the same point, which is this is all one trade. Gold moving first, seeing China start to move, then copper start to move, and all these things. It's all one trade. And that one trade is a macro trade based on a weaker dollar. And copper is also telling us that global growth is ticking up. Copper, people like to look at copper and go, "Oh, it's Dr. Copper. It means the United States is doing well." No, usually when copper does well, it's when we're in a weaker dollar cycle and money's flowing internationally because we start to see their growth cycle kick up. Now, I haven't seen the global growth cycle start to kick up yet by any means, but I think the market's telling us that's going to happen soon. And we're probably going to see money start to flow into those areas and continue to flow in those areas because the price action is front running the fundamentals at the moment, which is a pretty normal relationship. That we're going to see that, not saying the fundamentals as in normal fundamentals, but we're talking about economic data fundamentals, which are always lacking. If you're looking at GDP of a country, we're going to see it in the price way before we ever see it in the GDP of a country. But looking at all of these, there's just so much to unpack about what is going on with the market. Another thing that's saying global growth is probably picking up is lumber. Lumber is also saying the same thing. And then we'll end on this, which is silver. So silver short interest just hit a new all-time high. Sam found this one the other day. Really good chart here. So Kashop, what are you thinking about silver? Everybody's got these ideas that silver is not a monetary metal anymore. It can't ever catch up to gold because it didn't so far, even though it's actually outperforming gold year to date now, and kind of has been most of this year. So what are you thinking about silver here, Kashop?
So silver is a bit tricky, right? Because almost all the gold that's ever mined, except for the trace stuff that is found in your electronics, and that's goes to the junkyard. Almost all of it is still in someone's hands. So it's still owned. It's still actively owned. Whereas almost all the silver that's been mined, it's gone, and you could recycle it maybe if it makes sense, but mostly it's just gone. So for silver to pick up, it does not take that much of an incremental demand to send the price higher. And that's always been the appeal of silver. So just a little bit of incremental demand, and if mine supply doesn't catch up, it goes up. And there are no stockpiles like, with gold. If gold suddenly goes to $6,000 an ounce tomorrow, people will be selling their old wedding rings, taking their old laptops to the store and, recovering the gold from there. If silver were to double or triple, it would still not make economic sense to recycle silver. So that source of demand has to be met from new supply. It cannot be met from previously mined silver or stockpiles. So if you get a bit of a move, it's going to be a big move, because once the move starts, everyone's going to realize that there isn't enough silver and it's just going to get hoarded. So the short interest shows that maybe, just maybe, someone's massively short and they don't have the inventory to deliver, which is why they're kind of trying to suppress the price. And I wouldn't uh, put it past the big bullion banks to do it. So JP Morgan was actually caught, and three of their traders were sent to jail for spoofing the price back in 2019. I think they got out now, but that really sends a lesson that, don't indulge in market manipulation. But that's in gold, and I don't know if the silver traders have got that memo yet. And guys, this is not a conspiracy theory. You go to the government website, you can see they have laid out the entire case against the JP Morgan traders who did the spoofing. And you go to the Gold Antitrust Action Committee, they have again documented it. So, it may sound like something that's fantastic, like a conspiracy theory, but that's actually how the world works. So, I think this chart is interesting, and if it catches, then it's going to be explosive.
Yeah, I think it's on its way, right? I think that's the best way to put this situation. It's just on its way. I don't know when exactly it catches up to this thing, but it's on its way. And gold looks great. That's an uptrend, and it's not really a crazy parabolic uptrend. It's just trending nicely. Pullbacks are make sense. So I would assume some consolidation at some point, but who knows? This thing could just continue. That's the hardest thing to do as a trend following trader, which is sit on your hands, don't do anything, because this thing can go to any level that you can think of. And this is a chart of oil. So oil COT report recently is starting to look like a possible bottom here. Now, once again, like I can't from this is more of a short term, probably range trade. It would really have to close over $80 for me to get a little bit more bullish on this thing. But looking for a reversal in oil, for you guys looking for a bounce, that one's kind of set up. And so we'll end here with copper, gold, and the copper to gold ratio and the 10-year yield. So I think this is going to catch up at some point. I don't know when that point is, but I do think we're going to see that catch-up trade finally happen one of these years, pretty soon. And I think copper will start to outperform gold. I don't think gold will be in a downtrend at that time either. If you go back to even 2020, you saw that copper did start to outperform gold at some point, but gold was still in an uptrend at that time. So I think that's kind of what we're going to see here. And then one more chart. I forgot I had this one too. The CRB index is basically mirroring the 3-month to 10-year yield curve, which is pretty normal. As the money supply loosens up, money starts to flow into different areas. One of those can be commodities at times. And it looks like it is kind of flowing that direction. So I do like this chart. Now, once again, I think that this needs to kind of continue the same direction. I don't know if we're going to continue to see the Fed cut rates, but I do think that we're probably in for a little bit more towards the end of the year, maybe one or two. So, Shop, we'll end on that. Do you have any thoughts on what the Fed's going to do this year? I know it's a crazy thing to try to predict always, but we're always trying to be in front of that. So let's talk about it.
The Fed will do what the Fed does. Now, what you can do is look at what the market is pricing in and figure out whether they have it generally priced in or not. So, takes me back to the bond trade. So, we talk about how bonds are in a terminal bear market, but I had a really good bond trade where I was long bonds from April to September. And that's just because everyone had uh, said that no, the Fed is not going to cut. And the market was positioned completely lopsided. Short interest was like all time highs. The COT report showed positioning was completely lopsided. And so I just took a contrarian view, not because I would turn out to be right, but mainly because the cost of being wrong was so little because everyone was on one side of the trade. And you saw the same thing with Euro recently. EUR recently just shot up like a rocket ship because everyone was short euro and long dollar. So when it reversed nastily. So when I look at the Fed, I just want to understand how everyone is positioned. So it's not about playing the game, but playing the players kind of thing. So really, I'm not going to put out any prediction on what the Fed will do. There are some years where it's kind of clear. There are some years where it's very unclear. In fact, I wouldn't even be surprised if the Fed does a rate hike next. So
Yeah, it's
that's
it's it's
yeah.
literally the most unclear it's ever been to me this year. And yeah, there's plenty of predictions. There's plenty of Fed rate probabilities out there to look at. The best thing you can do is go to the Fed rate probabilities and try to see for yourself shortly before one of those events. Um, and that's kind of the best way you can look at that.
Yeah. So before we close, I just want to say one thing. So I have my newsletter. So I think it's a pretty awesome product. I've done a demo of it on this service a few weeks back. And right now I'm offering a 2-day free trial. So just go to kashifsriram.com/subscribe, pick the monthly option, and you get a 2-day free trial. So, go into the members area, sort of kick the tires, figure out if that suits you. And I'll be out with a new report on uranium tomorrow. So it's something I've been working on all week and I'm pretty excited about. So if you do subscribe, then, be sure to check it out.
Nice. That'll be a good one to read. Everybody's probably wondering a lot about the uranium market. I'm wondering your views on it as well. When you put that out, we'll talk about it next Friday. So let you put it out for your subscribers, and we could chat it through next Friday. All right, guys. Thanks for hanging out with us, and we'll see you next week. We're on every week at 11 a.m. Eastern Time on Fridays. We're also on at 11 a.m. for the Commodity Report on Mondays, Eastern Time.
Bye, everyone.